Okay. The last 15 minutes or so of the session is available for questions from the audience. So all three of our authors are willing to answer any questions that anyone might have. Yes, Jill.
Yeah, question for Shohini. Can you hear me okay?
Yeah, I can hear you.
I was curious, you talked a little bit about, and I have not had a chance to read the paper, so I will certainly after the conference, but was curious your perspective on, we've gone through some periods in terms of how unconventional monetary policy has increased deposits in the banking sector, and how also unconventional monetary policy with regards to quantitative tightening has put some pressure on deposits. I'm curious how you've thought about that in the construct of the paper and in your findings.
So that's a very good point. That certainly unconventional monetary policy and quantitative easing has implications for whether there's more of a savings glut that can occur if there's excess liquidity or if there's less liquidity in the economy. Our focus is primarily on looking at the cross-section, so looking at variation at the same point in time across regions based on the extent to which there could be more or less liquidity in an individual region. So in our empirical analysis, we try to account for variation at the aggregate level, which might be due to changes in monetary policy. But we find that at the regional level, the deposit rate reflects a local component of liquidity shortage. In terms of how do the effects differ across different monetary regimes, we find that the effects are actually larger in a period from 2010 to 2015 when there was virtually no change in the short rate. So it tells you that if you think that monetary policy can affect the predictive value of deposit rates on economic growth, it dampens the effect relative to if we don't have changes.
Yes, please.
Hi, Melanie Hall. I'm the commissioner from Montana, and it seems that it's only my mic that doesn't work, and I'm going to try not to take that personally. But I have a comment for Rohan and then also for Corey. Rohan, when you talk about losing a bank, I think it's fascinating because as the commissioner from Montana, I have whole counties in Montana that don't have even a branch, right? And so I think that the point around, is it a merger versus, a larger bank coming in and being able to provide better and different services, especially from a technology perspective, is a very good one. But also, I think it would be interesting to expand your research to look at the impact on communities if they lose a branch. A lot of times that for us, it's the loss of a branch in a community, and that can kind of be the death knell. We talk about, like, is it the bank or the hospital or local community healthcare provider that is really the final straw in the death of a community. So I would love to see that expanded to looking at branch losses in rural areas. And then Corey, I think we're going to be besties. First of all, I went to college in St. Petersburg, so love that area. One thing I wanted to mention to you, in Montana, the FDIC did research after the last crisis. And on your point on non-owner occupied CRE, I think it'd be fascinating to break that out. But I will tell you, in Montana, non-owner occupied CRE performed slightly better than owner-occupied CRE during the last crisis. I don't know why. I don't know what would have led to that. But I think we all assume, like you talked about, that investor-owned CRE would perform worse and is more risky. For whatever reason, in Montana, that wasn't the case. And third, you might have seen in here a few heads swivel in my direction when you brought up BHG. So let's chat. Thank you.
You want to have
thank you very much for that comment. And just as we look further into this, so we have, when we talk about maintaining presence, we're thinking about the branch as well versus that loss. And we do see that maintaining the branch is very important, right, in terms of continuing to support the local economy. And so that's something we've thought about, and in the current version, we didn't really put it in there, but we since looked at it, and losing the branch is also very detrimental. So it is sort of the connection to the community that's very important. And just linked in back to one of the comments that Corey made, that his instincts are actually correct. So we have, and as academics, you had to say, I have another paper, but I'm going to do exactly that. That we actually look at choices that acquirers make in this space. One of the things too, we use the word loss reduction in number because a loss doesn't mean bankruptcy. It just means sort of the title goes away in a sense, depending on how the transaction is made. But it does say that if it's a bank that acquires a local bank from further away, right, is much worse than if the acquirer, all else being equal, is a bank that's close. So Corey, your instincts are correct. So we're not that far apart. See, so you're okay. And also, as we mentioned, when it's a large bank, right? And so if you're broad policy is if a large bank from further away takes over a local small bank, then that's double bad, right? And so just kind of the implications. So I think your instincts are exactly correct. And the other research we're doing is looking more at the choices that are made, and specifically at the bank level, because that in fact is what's going on. Those variables are quite important.
Thank you.
Okay.
Yes, please.
Hi, Cedric Hollebroek from KU Leuven. I have a question for Shohini. So now it's very interesting that you show that these local average deposit rates can predict economic activity, but I was also wondering whether there's any added value in the dispersion of the deposit rates, because like as Greg said, there can be disagreement across regions, but I also guess that there can be disagreement within regions. So can you test whether this local deposit rate is more predictive if all banks decide to charge, to offer high deposit rates versus counties where only certain banks offer high deposit rates?
So your intuition is right on the money. When we started this project, we started by looking at the dispersion in deposit rates. And we found that the dispersion actually has greater predictive value than the average rate. Now we later changed to the average rate. And the second benefit of looking at dispersion is it's less sensitive to changes in monetary policy than looking at the average rate. We switched to the average rate because it's a little more intuitive to understand. But the mechanism works exactly the same way, which is the idea that if you have banks that operate in a region and some banks face liquidity constraints, whereas other banks are relatively unconstrained, if the banks that face liquidity constraints end up raising rates, that's going to increase the standard deviation. And so we show that the dispersion it does have added value above and beyond the average rate. It's also a strong predictor of economic activity, and that also incorporates some notion of competition in the local economy. Because if you think that there's only one bank that operates in a region, they're the only game in town, they don't have to raise rates by very much to attract new deposit funding. But if there's more competition, then banks have to compete more on rates, and then the dispersion becomes a stronger measure. And we show that there is, the measure performs better in places where there's more competition, and dispersion kind of encapsulates this heterogeneity across banks in terms of both the balance sheet composition as well as characteristics of the county itself, if it's more competitive or less competitive. But that's right.
Yes, Jonathan.
These were Jonathan Scott from Temple University. These were all really, really good papers, and Greg, I really liked your summarization. I guess my question is from Dimitro, but if you look at the aggregate call report data, the C&I proportion of total loans is about 12 to 15%, and CRE can be up to 30%. So I guess my comment is that in looking at this kind of the acquisition premium, getting back to the other comments, you do have the CRE part of this, and maybe you add them together. But there's also, and some people looking at CRE, analysts looking at CRE exposure will include multifamily, and that's requires a lot of expertise if you talk to the multifamily lenders, especially on the East Coast. And then you've got non-residential construction as well. So I think those are some components of the value of that premium you might want to think about.
Yeah, I think it's it actually related to Corey's point as well, that CRE has some components that might actually be more relationship-based and less relationship-based. So looking at data like granularity and try to exploit could be a good direction. Absolutely, absolutely. It makes sense. I put it down, so we will try that if we can. Yeah.
Next year's conference.
Yeah.
Other questions? Oh, yes, please.
Hi, Anya Clemeno, Federal Reserve Board. I have a question for Dmytro. I was trying to understand a little bit more about the mechanism you're using. I agree with Greg. It's a very clever way of thinking about mergers. When a firm is being acquired, their portfolio is being revalued to market value, fair value, kind of independently, not by the acquirer per se. So is it possible that kind of in the setting that you're looking at, the smaller loans are the ones that are remaining on the books and so they're valued, and maybe it's higher, it's kind of harder to value them, and the ones that are bigger are more likely to be on the books for a shorter period of time because they're maybe for larger community banks, they're more likely to be sold rather than the remaining books, and so maybe there's a difference in terms of which loans are there and therefore they're creating value versus the ones that maybe are there for a shorter period of time and therefore you're not picking up the market value of those loans.
Thank you. It's a very interesting point. What we are hoping for is that within CI loan category, for example, there is less variation from that perspective. For example, the loans that are more likely to be sold or securitized are the residential mortgages, for example. But when you look at commercial and industrial loans, whether it's smaller loans or larger loan, most likely they're going to have similar characteristics. Corey, do you agree with that? Because as a banker, I'm just wondering, is there any variation there? What's your opinion on that?
So we don't sell any, so
Yeah.
I don't have a great perspective on what would stick around or what's not. But what's available for me to put out there, sure, the residentials, but there's whole loans that are sold from the commercial real estate side too. So
Yeah. But that's definitely something that we're going to look into. Again, our hope is that, like you mentioned, the ones that are more likely to be sold or securitized are in a different category. Because the key here is not just the premium on small CI loans, but the fact that it's larger for large CI loans. So it's still within CI category. It's still within CNI category, but it's smaller one versus large. And then within the smaller categories, the smallest ones. So we hope that that breakdown kind of sheds a little bit more light on that. But it's a good point. We're gonna explore that. Thank you.
Please join me in thanking our three presenters and Corey discussing.
Great, and of course, thanks to you. Thanks to you, Greg, and I'll just echo my thanks to this panel.